Hey everyone! Welcome back to the Thrifty Finance Vision PH, where we make finance simple and accessible for Filipinos. If you're new here, don't forget to hit that subscribe button and click the notification bell so you won't miss out on our latest videos. Today, we're diving into a topic that many of you may be interested: stock market versus mutual funds. Which is better in 2024? Let's get started. First things first, let's talk about what these two investment options actually are. When you invest in the stock market, you're buying shares of individual companies. That means you own a small part of those companies, and your returns depend on how well they perform. The stock market can be pretty volatile. Prices can go up and down based on economic conditions, company performance, and even market sentiment. On the other hand, mutual funds are a bit different. They pool money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. These funds are managed by professional fund managers who make the investment decisions for you. As an investor, you own shares of the mutual fund, and your returns come from the overall performance of the fund. Now, let's talk about potential returns. If you're investing directly in the stock market, especially in high-growth companies, there's a chance to earn substantial returns. For example, investing in companies like SM Investments Corporation or Ayala Corporation over the past decade has been pretty rewarding for many investors. Plus, if you're holding stocks from blue-chip companies, you might even receive dividends, a share of the company's profits. However, with mutual funds, the returns are generally more moderate. But here's the thing: they also come with lower volatility because the risk is spread out across various investments. Over time, mutual funds can provide steady returns, especially if they're managed by experienced fund managers. Alright, let's get into the risk factors. The stock market is known for its ups and downs. For example, political instability or global economic events can cause significant market fluctuations. And if you're investing heavily in just a few stocks, you're facing concentration risk, meaning if one of those companies underperforms, it could negatively impact your entire portfolio. On the flip side, mutual funds offer diversification, which helps reduce risk. By spreading investments across various assets, mutual funds make it less likely that poor performance in one area will sink your whole portfolio. But remember, mutual funds are still subject to market risks, especially if the overall market takes a hit. Next up, management styles. If you're someone who likes having control over your investments, direct stock investing is for you. You can tailor your portfolio to focus on sectors you believe in, like tech, real estate, or consumer goods. But this comes with the responsibility of staying updated on market trends and making informed decisions. Active trading can be exciting, but it requires time, knowledge, and a tolerance for risk. On the other hand, mutual funds are perfect if you prefer a hands-off approach. They're managed by professionals who have the expertise to make the right investment decisions. This can be a great option for busy professionals or those who don't want to dive into the complexities of the stock market. Let's talk about costs. Investing directly in stocks usually means lower fees. You'll typically only pay brokerage fees or commissions, and there are no ongoing management fees. In the Philippines, platforms like COL Financial and First Metro Securities offer competitive rates. Mutual funds, however, come with management fees, usually between 1% to 2% annually. Some funds also charge sales loads, which are fees when you buy or sell shares. It's important to be aware of these costs as they can impact your overall returns over time. Liquidity is another key factor. Stocks are highly liquid, meaning you can sell your shares quickly if you need access to cash. However, the timing of your sale can impact your returns, especially if you're selling during a market downer. Mutual funds are also relatively liquid, but they're typically bought and sold at the end of the trading day at the fund's net asset value. This means you might not be able to react as quickly to market changes compared to stocks. Plus, some funds have redemption periods or penalties for early withdrawals. Now, let's touch on taxes. In the Philippines, capital gains from selling stocks on the Philippine Stock Exchange are subject to a 0.6% capital gains tax, which is pretty low. Dividends are also taxed, typically at a rate of 10%. For mutual funds, there's an advantage. They're generally exempt from capital gains tax. But keep in mind that dividends received by the mutual fund may be subject to taxes, which can reduce the fund's overall returns. So, How do you choose the right investment for 2024? If you're a risk-tolerant investor, the stock market could offer higher returns, especially if you focus on sectors expected to grow like technology or renewable energy. But if you prefer stability and professional management, mutual funds might be a better choice. You could even consider a balanced portfolio, combining both stocks and mutual funds to benefit from high returns while mitigating risks. Your financial goals also play a big role in your decision. For short-term goals, where you need access to funds within 1 to 3 years, mutual funds, especially money market or bond funds, are more appropriate due to their lower risk and stability. For long-term goals like retirement, you have more time to ride out market volatility, making growth-oriented investments like stocks or equity-focused mutual funds a good choice. Finally, it's crucial to adapt to market conditions. Keep an eye on global and local economic factors, sectoral opportunities, and inflation. For instance, in a high-inflation environment, you might want to focus on mutual funds that invest in inflation-protected securities or sectors that perform well during inflationary periods. In conclusion, the choice between the stock market and mutual funds really depends on your financial goals, risk tolerance, investment horizon, and experience. Many investors find that a combination of both provides the best balance of risk and reward. As you plan your investments for 2024, consider consulting a financial advisor to craft a strategy that aligns with your objectives and adapts to changing market conditions. Thanks for watching. If you found this video helpful, give it a thumbs up, share it with your friends, and leave a comment below with your thoughts or questions. Don't forget to subscribe for more finance tips and investment advice tailored for Filipinos. See you in the next video.